having me. I'm going to stand here so I don't block the projector. All right. So I'm here today to talk about Market Protocol. I'm one of the co-founders of Market Protocol. Market Protocol is a decentralized derivatives protocol. We'll talk more about what that means in the presentation. Melody mentioned that I've been a derivatives trader in the prop space since 2005. I've founded and run multiple 24-hour algorithmic futures desks on global exchanges. I first entered the blockchain space in 2015 as a trader. End of 2016, 2017, I became more interested in the technology side, and that sort of eventually led to what is Market Protocol. So one of the main issues that we talk about in general these days when we talk about blockchain space and things that are limiting the blockchain space is we primarily talk about scaling. Most of the times when we talk about scaling, we're talking about technology scaling. So we need faster blocks, we need more transactions, we need finality. It tends to be technology related. Another aspect of scaling the blockchain is price stability. So one of the things that people don't talk about as much is price stability. So sort of what that means is no matter how you view crypto assets, if you view crypto assets as a medium of exchange, as a store of value, as a utility application, until we can actually separate price volatility from utility, we can't actually achieve any of those goals. So if you think of crypto assets sort of compared to traditional assets, like for example, if we talk about Ethereum versus the US dollar, the largest move in the last year in a 24-hour period is about 35%, and that was actually an up move. As a trader, I would have thought that would be a down move. Compared to something like gold versus the US dollar, we see a 2% move. So that's almost 20 times larger in crypto assets. In terms of daily standard deviation, Ethereum versus the US dollar moves every day about 7.5% versus the euro versus dollar, which moves about 0.5%. So obviously that's just something we all already knew, is that crypto assets are much more volatile than traditional assets. So the way that we can address price scaling, the way that we can solve some of these problems is by using derivatives. So at the highest level, a derivative is just an agreement between two people to exchange the price or the value of something in the future. The derivative market in traditional finance is huge. It's way bigger than the spot market, and we primarily use derivatives for a number of things. The primary use for derivatives in the traditional space is hedging. It's an essential piece of risk mitigation. So businesses use derivatives to control their risk. So for example, an airline may use derivatives to hedge the price of jet fuel. A bank may use derivatives to manage their interest rate exposure. But at the end of the day, what derivatives are doing is they're allowing these businesses to scale by managing their risk. Another big application of traditional derivatives is for speculation. So derivatives derive value from something else. So when you trade a derivative relationship, you don't actually take custody of the underlying asset. So that means that you can buy or sell derivative positions without borrowing or owning the underlying. So one of the things that short selling does in the traditional marketplace is it helps reduce volatility. It's a piece of an efficient marketplace. The final thing that we just sort of touched on is it also simplifies custody of assets. So when we trade a traditional derivative, something like the S&P future on the CME, a trader will make or lose dollars based on how the basket of S&P stocks actually move without actually taking custody of the S&P stocks. So it dramatically simplifies trading. So that's just sort of quick background on what derivatives are and what they're used for. Another problem that we're addressing, and another problem, this was actually the first problem that attracted me to the blockchain space. Centralized exchanges and centralized infrastructure, is really something that a lot of different projects are focusing on decentralizing. So I originally got attracted to the blockchain space when I first learned about decentralized exchange applications and how that decentralized sort of one of the biggest issues I saw in the crypto space when I first entered the crypto space was custody of funds. So how we saw that best practice on an exchange right now is to remove your funds off exchange and store them in your own wallet to avoid being hacked. To me, that just sort of seems like a ridiculous reality and something that is really just a band-aid to a larger problem. So the other issues that we see with centralized exchanges is they control access, they control who can trade, and they control what people can trade. A couple other things that are issues with centralized exchanges, again, there's no real easy way right now to short or hedge digital assets. And then there's also limited exposure depending on what you want to trade or what the exchange is to either cross-chain or real-world assets from crypto. So that led us to what is the market protocol. I began working on full-time on market protocol in June 2017. That's when I stopped trading full-time and focused on market protocol. So we have two main goals with market protocol. The first thing is that we want to decouple price volatility from digital assets. And we believe that separating that price volatility is entirely necessary for the blockchain space to scale. Until a lot of people are talking about how we gain adoption, how we get people to really begin using crypto assets in the way that they imagine them to be used. Until we can separate price volatility from actual utility, people aren't going to hold crypto assets to buy a cup of coffee or use them as a store of value. The second thing is that market protocol is an open source, free to use protocol that allows the creation of decentralized derivatives trading and exchanges on the Ethereum blockchain. So that's what market protocol is. Those are sort of the two things that we're addressing with market protocol. So the way that market protocol works is we are on-chain for a number of different sort of traditional on-chain applications that are things like collateralization, custody of funds, position management, and accounting. That allows us to make sure that any contract or any relationship that's traded in market protocol is fully collateralized and always solvent. We're trustless for a number of different things like accounting and position management, and it lets anyone who's transacting a market contract sort of see what the current state of that contract is. This is an example of just sort of how a relationship in market protocol works. Basically, a market protocol contract is deployed to the Ethereum blockchain. This contract relationship is tradable by anyone who'd like to trade that. Prior to trading, users will deposit an ERC20 base token into that contract. At that time, the contract basically holds those funds in segregated accounts. When a trade is executed and Bob and Alice, say, agree on a price and actually choose to trade that, those funds then get locked in escrow in that contract for the duration of the trade. In this example, because it's a derivative product, the price of that instrument actually, say, increases. In this example, then Bob, who's short this relationship, will lose money. Alice, who's long this relationship, will make money. And they make the base currency in that contract, which is the ERC20 asset that they deposited previously. Market protocol is designed to allow for flexible contract creation because everything we do is actually derivative exposure. The contracts that are created through market protocol are very, very flexible and very open. So mainly market contracts involve a few different pieces. The first piece of any market contract is the ERC20 base token. So basically we allow holders and users of ERC20 assets to use those assets as collateral to invest in other relationships. So most often the collateral used in market contracts would be something like a wrapped ether or stablecoin. So we can use something like MakerDAI or Tether or something like Digix as the base token. So that's what traders will make or lose as their relationship moves. We use Oracle solutions to bring external data onto the Ethereum blockchain. So I'm not sure if everyone knows what Oracle is, but Oracles are basically they're trusted solutions. So there's something that we basically say, here's a data provider that's going to publish or bring that, make that information available on the Ethereum blockchain. So we have an alpha product that was written to oracleize it, but plenty of other companies are working on this. So like Thomson Reuters is a product called Block 1 IQ. That's another way to get data onto the Ethereum blockchain. And there are other options. Then we have the reference asset, and that's what we're going to derive value from. Okay, then let's just talk about, I guess, the tech here. So we're a protocol layer. We're written on top of the Ethereum blockchain. On top of Market Protocol, different third parties will create DApps that do different things. One of the first things that people will create are exchanges that are written on top of Market Protocol. These exchanges then can trade any contract relationship or any Market Protocol relationship that a third party has created. I just want to go over a couple different use cases of Market Protocol to kind of illustrate some of the points we talked about before. So one of the primary use cases of derivatives, as I mentioned before, is hedging. And right now, it's very difficult to hedge crypto assets. To hedge crypto assets, you basically need to sell those crypto assets or synthetically sell those crypto assets. So a good example would be if you own crypto assets or tokens to access a platform. For example, if people are familiar with a project called Salt Lending, but basically Salt Lending is a platform where you can borrow fiat against your crypto holdings. To access that platform and actually borrow fiat, you need to own Salt Lending tokens. The actual token price of Salt in dollar terms has moved from $2 to $20 and back down to $2. It's probably traded around $3 now. So anyone who owns Salt Lending tokens to actually access the platform experienced way more price volatility holding the token than ever hoped to gain in utility from using the platform. So that's an example of something that really needs to be addressed. So with Market Protocol, if someone creates a contract that's make or die against Salt Lending or Ethereum versus Salt Lending, that allows them to hedge that relationship and isolate the utility that they hope to capture because they may not actually care about the price of Salt Lending tokens. Another good application for an on-chain application would be, say that we have staked Ethereum, and when our Ethereum is staked, we're receiving a stake reward, but we are not. But the token is actually locked, so you have exposure to price, but you have no liquidity. So with Market Protocol, you can actually hedge the price of Ethereum and just only isolate sort of the stake reward that you're hoping to capture. Another application of Market Protocol, because everything we're doing is derivative exposure, that means that we can create cross-chain relationships. There are a lot of different projects and a lot of different people that are focused on how do we enable cross-chain trading, how do we generate the atomic swaps, how do we sort of accomplish the custody. For most people, custody is not really what they're after. When I trade, say, Monero or Dash or whatever crypto asset I'm trading, to me, custody is actually burdensome. I don't want to take custody of 15 different crypto assets in a dozen different wallets. It's really just makes it more difficult. So with Market Protocol, because everything we're doing is derivative exposure, I can actually create contracts and create relationships that stay on the Ethereum blockchain, resolve in ERC20 assets, and don't involve custody at all. So I can create Ethereum versus Bitcoin, I can create Ethereum versus Dash, I can create Ethereum versus a basket of crypto assets, and trade that all on the Ethereum blockchain. So that dramatically simplifies custody and dramatically simplifies that trade. Finally, we can create off-chain relationships with Market Protocol. So using the same mechanic of base currency of, say, a make or die, we're using an oracle to bring the price of off-chain assets onto the Ethereum blockchain, we can derive value from traditional assets. So we can actually recreate a relationship that's like Tether or make or die against Apple stock. So what that effectively does is that recreates traditional relationships without ever having to go back to fiat and maintaining your position on the Ethereum blockchain. You can create relationships like Ethereum versus Apple. We can create really kind of almost anything we want. So we can create a housing index, for example, that pulls data from this block in Hong Kong and it's designed to be very flexible there. The first version of our beta is out now. It's a DApp that basically demonstrates and shows the process by which someone would create a new contract relationship. So in this example, we're using Ethereum as our collateral. We're making or losing Ethereum. We're going to pull the price of Monero from Binance, and that's how we're going to settle and create this contract relationship. Then it allows us to test our Oracle query and make sure that we're getting the price of price of Monero in a format that we expect it to come in. Then it allows us to deploy that contract to the Readme test network. We also have a contract explorer then that allows you to view and see the status of other existing relationships. That is something that we just released. That's sort of our first DApp. Second DApp is going to be out towards the end of the spring, and that'll be sort of a simulated exchange environment. Right now, as I mentioned, we're open source. We're looking for contributors. Everything we've done is public. We're happy to talk with Melody sort of mentioned. One of the things we're working a lot on right now as a protocol is we're looking for application partners. We've announced a few partners recently. One of them is a carbon emissions broker in Singapore who's building building out a lot of their sort of OTC carbon business on top of market protocol. This is one of the things that they're doing. We just announced a partnership with Digix to use Digix DGX token, their gold stablecoin in market protocol, to also use their spot gold price oracle. The other types of integrations and the other projects that we're working on, we're talking with a number of different wallets, for example, to offer kind of interesting value-add services. So, for example, right now there are a lot of different wallets, but they all kind of offer sort of similar functionality. So one of the things that you could do if you had a wallet is you could offer price stability to your wallet users. And basically, you could offer that stability by hedging with sort of market protocol in the back end. The user of that wallet may not even know how it happens. They just know the result is all of a sudden the price of my Ether doesn't move 7.5% every day. So that's a different kind of application that we're seeing on top of market protocol. The point is there are many different, we're talking with a couple different groups about getting their price data on the Ethereum blockchain from exchanges. But yeah, that's high level what market protocol is. There's a lot more to it, but that's all we're covering for right now. So are we doing questions now or later?